Hi. In part one of the global investing landscape video, I have covered about how do we look at the world markets under one roof, under one prism through the U.S. stock exchanges, and the opportunities we have to diversify our portfolios beyond our domestic markets. And with in India itself rising, the opportunities for Indians and the NRIs and the U.S. citizens who are from Indian origin, and the foreigners who want to have a global view, have an opportunity to invest in global markets. This is the part two of the video where I'll be looking at the current market assessment with respect to the U.S. markets and the opportunities that may come up to for us, from time to time. So. It's very difficult and nearly impossible to predict the markets. All of us honestly agree. We just don't have the capability to predict what is going to be the future of any given market. But as the legendary Mark Howard mentioned, so whatever we learned a lot from some of these legends. So it's a courtesy Mark Howard. It's important to have an assessment skill. Where do the markets stand today? That if, for example, it's like, a temperature. Do you have the fever or don't have the fever? Now, fever may go up or, that's different. That we can't say. But today, where are the markets expensive? How expensive they are? Are they going to be more expensive? Are the markets cheap? Are they going to be more cheaper? The going to be part we can't answer. But today, we should have a fair view of where do the US markets stand today. Okay, so I'll take two, the market can be assessed based on the index, right? So I'll take two indices from the US markets. One is the NASDAQ index. The second one is the Russell's index. NASDAQ index is the large cap composite index. So I'll talk about that and how it has performed in a bull phase and where is it with respect to the corrections. Then I'll quickly take you through the Russell's index, which is a small cap index. Now, in the NASDAQ Composite Index, the ticker symbol IXIC, okay, it's an important large cap index that constitutes predominantly companies from the tech sector, with more than 50% of the market cap of the constituent stocks coming from the technology sector. It has other sectors also, but the tech sector accounts for more than 3 times its any other sector that is forming part of the NASDAQ index, NASDAQ Composite Index. Now, how it has performed? Because US is a very mature market, you'll be surprised to know that a large cap index has fared better than a small cap index. So as per the data I have and what I've seen from the stockbroking terminals, but I'll explain the differences. So the NASDAQ Composite Index, the IXIC, has recorded a high of 16212.23 in the month of November 2021. Forget the index numbers and all, it's not very important. The level can be anything, but what is important bit, how much has it moved by, in a period of whatever the bull cycle that we are referring to. Now, bull cycle references, we can go back in time to 10, 20, 30 years also since its inception. That's not important. So, I am taking the reference of 2009 lows where there is a global market low. Since then, the NASDAQ bull run continued till 2021, from 2009 to 2021. And if you look at from the lows to highs, it's only recorded gains, and I don't think any individual would have gained that level of capital gains in the real sense, because it's not possible to buy exact low and then sell it the exact high. So it has recorded a significant CAGR of almost like about 22.2%. That's a phenomenally high number at an index level. So the stocks have given a lot more returns from low to highs. So it gives us a perspective, and that over a period of time. This is only a hindsight benefit we have. Nobody in 2019 would have predicted, many of us would have predicted that the bull run would continue till 2021. So that's a disclaimer we should always live with. But on hindsight, if you look at it, for people who had the patience to buy low and held on to it, they have made significant gains even at the index level. At the stock level, lot many people have made lot more money. That's different matter. So that's the level of returns. So even if you cut off say 5, 6, 7%, so 14, 15% return, people would have got who have held on for such a long period of time, which itself is a very difficult thing to do. Now since then, what happened? From 2021, the NASDAQ is in correction mode. So it fell by around 37.77%, and then there is a rebound, which took it to the recent highs of 12,200 odd kind of a number. Okay, but will it correct further? There is a possibility, because the crisis around the world is not yet over, and US itself is a major influence in the global arena on the economic domain and various other domains. Probably the crisis also ends when the US correction also ends. We don't know. There's no correlation between the two. But we are in the midst of a economic crisis. We are in the midst of a global geopolitical crisis and whatnot. So there is not because of the crisis the stocks are correcting. The stocks normally correct because they're overpriced. And when the events such as high inflation, high interest rates, and geopolitical tensions arise, people panic and sell. And the smart investors always sell because they know that this has overrun. The bull market has outlived its life, or it has given abnormally high returns. So your the price you are getting when you dispose of your assets is far higher than probably the enterprise value or whatever the intrinsic values of the underlying businesses in which you have an equity stake. So that's how the game gets played. So the correction is on, right? So one has to be careful, but does it mean that we should stay away from the markets? Probably not. So you should have a menu card of your own stocks, and you have to start nibbling them if you are a do-it-yourself investor. If not, you have to look at platforms that have some credibility, where the advisors or the research analysts have started giving some decent returns. So you have to start nibbling and then have your own. You have to build your portfolios. If you are new into the market, or if you have disposed of your assets in stocks and then you want to rebuild, so whatever be your position. So we can't address individuals based on their risk profile, but largely the market opportunity, the US market provides opportunities to re-enter because there is a massive correction that is going on. That's a fact. Now let's quickly look at the small cap index. Right, the small cap index has actually given slightly lesser returns compared to the large cap. If you compare the lows of 2009 to the highs of 2021 kind of a thing, that's about 16.8%. So we have no answer as to why small cap has given lesser CAGR compared to a large cap. US market is different. In India is different. Small caps tend to give higher returns, and then they also have deep haircuts, the small caps. So people lose a lot of money in small caps if you don't exit on time, or if you pick a wrong stock. But I think US market is a very mature market where they are global giants. So and because they, unlike any other market like say India or even China, US has a leadership outlook in spreading its businesses across 140, 150 countries. So you name any large business, they come with a wonderful risk management templates and compliance templates. But for them, one market global economic unit, is one. That is why the size, scale, and complexity they have is far higher. Hence, they continue to do it even if they have saturated their sales in the domestic market. So, quickly looking at the small cap index, we have a good bull run during the same period, but it's correcting. It's corrected about 33.24%. It had a mild rebound of 23.67%. Is the correction over? That's anybody's guess. But in my view, the correction at a stock level, at least definitely for some of the stocks, is ongoing. Do you want to wait till the correction is over? Probably not. So do you have to nibble? So you have to be a stock picker when you're trying to do these building portfolios, and you have to start nibbling based on the value zones. When the stocks get into a value zone or buy zone, then it's a dollar cost averaging rather than a massive lump sum picker buys in one go when you're in the midst of an ongoing correction. So that's the broad market assessment I have for these two markets. But needless to say, these markets give phenomenally good opportunities to invest. And we have to be ready with the dream stocks we want to have, or we want to have portfolios around. So I'll see you on the other side. This is a disclaimer that we can't predict the markets till it's either the bull run or the bear run is over. Within that uncertainties, a market assessment tells us that at a stock level, some of the stocks are expensive still, probably expensive. Some of the stocks are in the value buy zones. There are opportunities, there are threats. So one has to go through this whole assessment and then slowly pick and choose very carefully those ones where which are which are pretty cheap, or beaten down, but inherently they have that future earnings potential with them. They are going through a crisis right now, so those are the things which one have to look at. So you'll be seeing some very so I'll be live with respect to some of my research and analysis on US stocks very soon. So you will hear from me soon. So till then, goodbye, and wish you all the very best in your investing journey. Thank you.